All right. So I want to thank everyone. Welcome to the first Cherry Live session. These Cherry Live sessions are hosted by Cherry Health and really meant to cover different topics and speakers and situations that matter to healthcare professionals across Canada. If you're not familiar with Cherry Health, it is the medical network across Canada. If you haven't joined yet, check it out at cherryhealth.ca, and we'd love to have you join. Today, we are joined by Mitch Mastel, who is a financial advisor with Raymond James. Mitch is very familiar with the physician space, having grown up with a dad who's actually a family doctor as well. And so he brings that level of knowledge and experience to everything he does in working with physicians in his work. Jordan, who is also here as a panelist, is one of the co-founders of Cherry Health and is also a family doctor practicing here in Calgary. So today, we are going to really focus on people's awareness, understanding, and any questions that you might have around financial health and financial advisors and investing. So those types of topics. We've heard from a lot of physicians that we work with, and Jordan can jump in, shortly here and comment too, that investing, setting up for the future as a physician, that financial wealth and financial health is often a topic that people push off, and often something that they're not feeling comfortable early on in having conversations about or diving into, whether it's because they have debt, whether it's they have other things holding them back. And we want to help people break down some of those barriers that stop them from getting started. So I'm Alita. I'm also a member of Cherry Health, and I'm going to be facilitating the conversation today. There is the Q&A open to everyone. If you have a question, please pop it into that Q&A section and I'll be addressing those. We'll talk for about 35 minutes, just conversationally answering some of those questions and talking about Mitch and his experience, and then Jordan's as well. And then we'll open the mics after that to any questions that anyone might have from a discussion perspective. So Mitch, let's start with you. Why don't you introduce yourself and tell us a little bit about what got you into this industry in the first place as well.
Yeah, hi everybody. Very excited to be here today and glad to be partnered with Cherry Health. I think they're doing something pretty special. So just a little bit about myself. My background, I started out in the world of accounting at Ernst & Young, learned that side of the business, and then I ended up at National Bank for a couple of years while I did my CFA, always wanting to do what I'm doing now. That was always kind of the end goal. Several years ago, I made the jump over to Raymond James, and it's not by coincidence I ended up at this firm. Because we are independent, we're not a bank. We could run our business our way, and I watched my dad as a family doctor, and my brothers. I have a couple brothers who are actually also doctors as well. One's still doing his training. One's an orthopedic surgeon in Saskatoon. I find it a unique subset of clients because I see a lot of potential if you do it right and start early and building that wealth over time. And so I find it interesting to work with doctors. I've worked with a number of them and a number of professionals from my network. That's kind of what makes my business. And it's been a great focus, and it naturally just has evolved into kind of my client set. So this has been a good partnership with Cherry Health and trying to continue on that mission. Yeah.
Jordan, why don't you introduce yourself?
Well, I'm Jordan. I'm a family physician. My background, obviously, in healthcare and then the tech startup space. So founded Cherry Health a couple of years ago now. We just had our 3rd anniversary last month. And so I'm doing part-time practice now as a family doctor, working in the weight loss management space. And then most of my week is actually spent in the software tech startup world. So happy to be here and learn a little more about finance, because it's still a big black box of mystery to me as a newer stage physician.
Yeah, I think that's such a great comment, that black box, and still a piece that causes a little bit of resistance, maybe a little bit of unsureness and all that kind of jazz. And while that's true for physicians, I think it's true across the board for many people. But Mitch, why don't you tell us a little bit about your experience working with folks who are earlier stage in understanding investing and working with a financial advisor, and what that really entails, what that means.
Yeah, for sure. So I'll kind of dub this down to the simplest terms because I don't know everybody's kind of entry-level experience with investing here. So working with a financial advisor, my job at its core is to be your personal CFO, your financial quarterback, and oversee everything from a holistic view of your financial well-being to help you achieve your goals over the long period of time, short and long-term goals, I guess we should say. So starting with, some of the doctors for, they've been in school for a long period of time, typically will have accumulated some line of credit debt and other student loans. And the conversation often happens is, well, where do I begin and what level do I start investing and building equity? So everything in this world, and my view of things is everything is, you have assets and you have liabilities, and that equals equity. And we want that equity number to go up as fast as possible. So people will often, there's two things with, if you do have a debt. One is some people go, oh, should I pay off all that first before I start investing? Well, that might make some type of sense. People, if they have debt, there is a way, if we return over the interest rate on the debt, you could basically mathematically be ahead. So there's an actual two things. One is actually what's the math tell us, and what's the other thing is what's people's emotional connection with debt as well. So one of our the biggest hurdle starting out is coming up with a game plan to pay down any debts and build equity at a pace that's appropriate for the specific individual and client. So that's one of the biggest hurdles off the get-go.
Like that. So understanding, people often don't think that it's time to get started with a financial advisor or started on this until they've paid down their debt. And what you're saying is don't wait for that. Start the conversation early and start coming up with the plan. And it may be that it's not the right time, but there's also things that you can do to get started early on.
Yeah, absolutely. So, well, the big thing with us too is like, I'm happy to meet with any, knowing the potential, and it's all about doing little things over the long period of time. If you've just ended school and you're, say your early 30s or even late 30s or what, the idea is you're a younger, like relatively younger, with high earnings potential over your career. And it's about doing little steps over the long period of time. So we would essentially come up with a game plan where we would pay down debt at a certain pace, and we will track that progress over time, and at the same time build equity. When interest rates were almost zero, it didn't really make a heck of a ton of sense to be rushing to pay off that debt at a super high speed, because you're essentially buying yourself a 2% rate of return when interest rates were low. Every dollar nowadays that you're paying off your line of credit, if it's floating, is basically buying yourself a prime minus 0.5 rate of return. So that's now, let's call it 6%, just to keep numbers simple, right? So that is part of the puzzle. And then also, if you have different types of debt, one, you might have MasterCard, credit card debt, line of credit debt, and student loans. At what pace do we pay each of these down? And that'll be part of the practice as well. And then coming up with a plan. Okay, if we put some money in RSP, we'll end up reducing our earnings for the year, and we could put that against the line of credit. But basically coming up with a game plan to build equity at a pace that's suitable for you. So that's kind of the crux intro part. I see one of the biggest issues I've seen is where, on top of like just deciding a pace of paying down debt, is if you have it, is that sometimes if you don't have a plan at the speed to pay down things, what happens is you go out and buy, a car and a new house, and then 5 years later they go, oh, my line of credit is still $350,000, right? But having a plan in place where, okay, here's your earnings, here's how much you spend every year, and here's the pace at which you can pay down debt and build equity, that's important to do. And having that conversation and walking through the numbers is important to do. The second thing I see the issue doing is people, and I work with a number of doctors and professionals, and this happens early on, is they will try it and they don't really understand their risk tolerances, and they'll try and hit a home run in a one-off investment, and it'll be super high risky, and they'll put a large sum of money in. And I've seen this happen multiple times, not saying that everybody would do that, and it ends up like, you could lose money. And if you lose another, $50,000, $100,000, that takes a long time to pay back. Especially, and sets you behind in terms of the long-term time horizon. And even worse than that, if you do that in your TFSA, you're never getting that contribution room back. So it's about doing little things over the big period of time, even if you're putting in $6,500 a year into your TFSA and did nothing else, and invested it in a conservative way, earning 6-8% a year. You get your bogey, as I call it, and you will end up, that's going to be $1 million account in 30 years, 35 years on its own without tax. So, I mean, it's about taking little steps from an earlier stage and coming up with a game plan versus, waiting another so many years until, you're behind the 8 ball.
So you mentioned, and Jordan, I want to come back to you shortly from to ask about your experience, sort of as a physician who has earlier career, about what you came out of, school thinking and how familiar you were with this. But I'm going to come right back to that. But I want to ask one more thing, because you mentioned this sort of Hail Mary investing, hey, I see something and it's got a lot of, buzz maybe going on out there. I hear about it talked about in the media or this, that, and the other. Is there a time and a place where people can play with some of that buzz and play with some of that? Like, how would you recommend people to still, feel as though they're having a bit of fun with what's going on out there, but also, maybe being a little bit more prepared and a little bit more strategic at the same time?
Yeah, of course. Well, so you're always going to see exciting things, and people talk about, investing's fun, right? So it is fun, but you don't always have to be sexy to be successful at it, right? Like Warren Buffett gets rich slow. That's why people like, that's what he says, people don't like following a strategy, because you're going to get rich slow. Everybody wants to get rich quick, and that's not the goal here. But the idea behind it is, with like, say me, I become your financial partner, right? So if you hear one of these ideas, it doesn't mean we can't buy. We could absolutely buy anything in your accounts. It's your money. But we have all the research basically where we can look and see how things have done. Have equity research from professionals whose job is to analyze stocks, and me, who used to be an equity research analyst, and can read this research and talk to the analysts and decide if it actually is a good idea or not, right? So, for example, and I hate talking about it, but I saw a lot of people that have their whole TFSA in 2020 in Bitcoin, and it's just not, as one, the right account to put that in. Two, that's just way too much exposure to one asset class at all. And I always say, like, not to go down this rabbit hole, but when you're dealing with something like that, it isn't a company, it isn't a business, it's all speculation. So it's a high risk investment that you're pretty much gambling on. I'm not even going to get in the discussion of that asset class, but just as an example. So you can absolutely, but you want to have the correct amount of risk to a certain asset. That's why we build the diversified portfolio. You don't just go put all your eggs in one basket, right? A good example of this, and I see this all the time living in Calgary, is we will have, and this is not medical, but people that are an engineer working at Canadian Natural Resources. And they'll come to us and they'll be like, here's my net worth, I got $1 million. And they'll have $700,000 worth of Canadian Natural Resources stock that they've accumulated over the last 20 years. And as good of a company as it's been, and it's trading at $75 now, I've seen it be 12. And so it's pretty hard when you go to retire and go, oh boy, the market crashed, and now I actually only have $100,000. So, you don't want all your eggs in one basket, especially when you work at. So it's about building a diversified portfolio and believing that, the economy is going to grow and companies are going to do well, and we'll build wealth over time, right?
Yeah.
So,
and I think you kind of touch on something else that's so important, is tap into a resource who has spent a lot of time getting to know this stuff, who's spent as much time. I mean, you're a CFA and a certified accountant as well. I mean, you spent as much time getting to know this industry and getting to know this as doctors spend getting to know how to be a doctor. So, hey, let's rely on people who have, some depth of knowledge when we're trying to make some of these decisions. But Jordan, I want to come back to you a little bit here as a physician who was earlier in your career. Back to my question there, what was it like for you coming out, and tell us a little bit about what your thoughts around investing were, because I think that's probably pretty relevant to our audience and pretty on the ball for a lot of them too.
Well, yeah, so started earning money all of a sudden, like the switch flipped, and now you have a career and an income. And then it was kind of a, what do you do with this, right? Like, no previous experience in that, like just living off of a line of credit. So there was no actual like income or investing to be done. So it was basically like starting from scratch, like infantile level of knowledge. And then so if you have the giant line of credit, like your student loans from the federal government, from the provincial government, from the bank, just going through med school and residency. And then, I don't know, the number one thing you think about is that kind of looming over your head, or at the same time, you're like, should I just leverage invest and tap that all the way out? Like, I don't know, what's the current kind of, meta and advice in terms of the line of credit and the interest rates now? Like, are things going to go all the way up to 18%, like our parents might have seen before? Like, should we be aggressively paying that down, or is it okay to like hang on to it slowly over time?
Yeah, I mean, twofold on that. So one, interest rates, I don't foresee them going to 18. Just a little background on how rates work, and the reason why they've been higher is because they're trying to beat up the consumer because inflation is high, right? So you have monetary and fiscal policy, and monetary policy is determining your interest rates in the market. And the idea is, for the Bank of Canada specifically, is to get inflation and GDP, being the economy growth, to be equal, about 2% a year, right? And so what's occurred, though, through COVID and excess spending, is everybody's got a bunch of extra cash and rates are low. So people are out going and buying new cars, new boats, new houses, new everything. And that creates a high inflationary period. And then there's also another issue why inflation's been high, is because there's supply chain bottlenecks, right? So it's kind of a two-factor issue. And what occurred last year is they thought, okay, let's start raising rates. It's time to start raising rates. We're coming out of COVID. And naturally, we're going to have what's called a soft landing. Inflation will come down naturally, and we'll be back on track. But that hasn't occurred. It has to some degree, but inflation has come down to a bit. It hasn't come down as much as they wanted. The issue with raising rates, though, is that it creates credit risk. So you've seen in the US where rate increases, even though those banks that went bankrupt, regional banks, were invested in very safe securities at 2%, their equity value of those securities becomes negative. And so basically it wipes out all the value of the bank. They didn't actually have anything that was like high risk and going to go bankrupt in there. It's just that your equity imploded. So that's the rates. I think rates are going to stay higher for longer. I think we'll probably have some more rate hikes throughout this year, probably small rate hikes, 0.5% to 1% more, and they'll be held out longer until inflation comes down. So that's the number one. So on that fact, as soon as every new dollar I see you have, every new dollar earned, you have an ability to do anything you want with it, really. But it becomes a new decision. Do I pay down my line of credit or my other debts, and which debts do I pay down? So the first thing, we decide, okay, and this could be every month when you get paid, a decision-making process. Okay, what do we need to pay down? And it'll be down do you pay your line of credit? Do you pay your MasterCard bill? Do you pay student loan? Well, you're going to pay down. And by the way, if you have room on your line of credit and you have $20,000 in credit card debt, you should definitely take the line of credit and pay off the credit card. So you want to pay down the highest levels of debt first and consolidate them into one piece, and then the lowest interest rate debts last. So when you're investing technically with borrowed money, the second that we make that decision to invest the money versus pay down the line of credit, the decision needs to be that the rate of return on the investment needs to be higher than the line of credit interest, or the interest that you're being charged on your debts as a whole, right? So if your interest rate, like I just quoted, 6%, prime minus 0.5, just to make numbers simple, is 6. Well, I'm not going to go buy a bond with that money that earns you 5%. You'd be a negative 1% return. But if there's a structured note that pays 12, okay, that might make sense, right? So there is some decision making around that. When rates drop down to a really low number at 2%, then it made a ton of sense to okay, let's maybe take a pause on paying down the line of credit and put money towards my TFSA and my RSP and build those accounts up. So I know I would not go and fully lever it all and try and hit a home run right now. I see it as new dollars coming in because you are growing, like everybody's, I would assume, is starting to work and earning some income, and that income is going to grow every year. And so it's a decision that'll be ongoing as things occur. And that's what, we're here for. And I can see opportunities in the market. If I went and bought Enbridge today, Enbridge is traded down $48. It pays a 7% dividend. And I went, okay, it might make sense to buy some Enbridge this month, or TD Bank, or TELUS, all pretty safe. If you bought those three stocks on its own, you'd have a 6% yield, which matches your interest rate plus upside. So, but if you asked me that same question 6 months ago, I'd be like, no, pay down the line of credit.
Yeah, so that's what I'm hearing is there is no one size fits all. And it's really taking a look at where you're at, what your earning potential is, and what levers there are that should be pulled at that right time in space for that particular person and for their situation.
Oh,
That's
definitely.
interesting. Like I never even considered like the dividend. That just kind of shows how rookie I am at this. But yeah, like it's always just like, what's the equity value of these securities that you'd be buying, and then does that go up or down, and then that is the return. But in terms of just like big established companies generating revenue, just having dividends come out of that actually makes a lot of sense.
Yep.
Yeah, well, exactly. And the thing is, when like talking about companies, so when you invest, right, the lowest risk thing you could do ever is have money in your savings account at the bank, right? That would be essentially the risk-free rate of return. It'll pay you a little bit of interest sitting in there. But what people don't see is what your money, if you just sits there, is deteriorating to inflation, right? Every year your dollar becomes worth less. The second lowest class thing would be buying a GIC, right? Okay, here's a 5% for whatever amount, 5 years, whatever the government's offering. It's locked in. You can't touch it. And
what does GIC stand for?
Like a government investment, like why can't I think of it off the top of my head? Anyway, a GIC is basically a deposit from government savings.
Okay.
And so they will pay you a rate of return. Yeah, and they'll pay you a rate of return. It's basically the interest rate. And the prime interest rate generally depends what the yield curve's doing for different periods of time. Okay, right now, pretty flat yield curve, roughly 5%, let's call it. It's locked in money. You don't have access to it. You can't cash it out. Okay, that's the downside to it. You're not going to go do that if you have any sort of debt, because you'd probably be lower than your interest rate. The next level thing would be buying a bond. A bond is when you loan money basically to a corporation, a municipality, government of Canada. And when you buy a bond, it's called fixed income. Bond is a type of fixed income. And fixed income, we know the return profile the second we buy it, if held to maturity. Every bond will be like this, your principal amount needs to be paid back at a certain period of time. Okay, so that'd be the next lowest thing. Second we buy it, we know the yield to maturity. The next up the ladder, to keep things simple, there's different ways you wrap things in between, is a stock. And stocks can have different levels of risk depending on what you're buying. So you have companies that are blue chip, and where I'm coming back to this is names in Canada, like your Enbridges, your Teluses, your banks, highly regulated oligopolies. They're well-established companies, been around for 100 plus years. Enbridge has raised its dividend every year for the last 36 years. Mm-hmm. They are generally lower volatility, don't move as much. Mm-hmm. In the US, you might have Google and Apple and Amazon. They don't pay you any money to own those. Like, they don't pay a dividend. Mm-hmm. Well, Apple does, but like Amazon, for instance, doesn't. your shares increase in value is how you make money on it. And the reason it does that is because the company grows. And so all their profits go back into building the business. And those names, while they've done extremely well, and I anticipate they will continue to do extremely well, you're betting on the growth of those companies. And so they're actually, in terms of how you value a business, price to earnings generally, are more expensive and are more volatile, right? So the more yielding names, more established, less volatile, pay a dividend. And then you'd have like venture, which would be like more speculative investing. So in the terms of the range of like just stocks, there's a lot of different types you can buy. And that's why you have to have a balanced portfolio. And you develop a portfolio that gives us a level of income that we need to pay off your interest on your line of credit, match it, at least with upside. Or if you retire, like, okay, say you needed $100,000 to live off in retirement. Well, okay, if I earn 5% on $2 million portfolio, that's $100,000. Yeah. So that your actual asset allocation through your lifetime over your period of, from when you're growing to when you're established to when you're retired to when you're old and gray will change, and we'll adjust. So,
and that's the goal, really, is to see where people are at. We're talking a lot today about early career and probably having some of that debt still, but obviously it's your role to talk to people who are at different stages of their career and closer to retirement or earlier stage. So for those who are earlier stage, and Jordan was talking about being like, oh, I didn't even know these things exist, and I feel like I have all this debt, and some of it's credit, some of it's line of credit, all these kinds of things, student debt. If a person's going to meet with you, how do they need to prepare? Is there anything that you expect from them to have, information on, like, what should a person think about when they want to meet with you?
Yeah, for sure. So first of all, like, I'm a little bit different in how I operate, in the sense that, like, I love what I do. Doors open, happy to chat with you. I'm never going to be like, you sign up today or else I'm not helping. No, like, it's a long-term process. And I'm young. I want to be in this business for a lot of years, and I like working with professionals that have a lot of potential. I've basically taken people from ground zero up. I definitely and you'll be surprised, like, with your earnings, if you do it the proper way, it's going to scroll into a good number, and you'll be very comfortable, more than comfortable if you do it right. So generally how the process works is, if we'll meet, and the thing is, we will get to know one another, get to understand your situation, right? So you don't necessarily need to be like, so step one is being like, hey Mitch, let's have a conversation. I'm happy to do it, and take the time to do it, and as much time as you need. And the first thing is getting to understand your situation of what's going on. That doesn't really take prep. We kind of discuss what your concerns are, what your goals are, what's your family look like, what's your, do you want to work part-time, or are you really putting, the pedal down and want to burn the candlestick at both ends? And we'll kind of figure those things out, and that could change, right? Like, life happens, right? So the second part to that would then be, okay, let's establish a game plan. And when that comes into play, we basically at that point need to open the kimono. I need to understand, like, what the numbers are, right? And the more we know, the better. So in terms of, how much line of credit you have, how much, if you have any, do you have a corporation, which we haven't really talked about yet. I'm well-versed in working with a number of corporations, or should I have a corporation yet? And then in terms of, like, all your any current investment account statements, all that basically information I'd walk you through. And so, it really, depending on what we talked about in our first call, in our first meeting, we could start to gather kind of the information, and that is used to basically develop our understanding of you. The better we know that, the better we're going to be able to serve. And then the relationship grows over time. So we'll open accounts. That's easy. Doesn't take much work. Pretty basic information. Any transfers come in kind. If there is transfers, there's no cost to transfer. And then we come up with a savings and investing plan for you, whether that be into your corporation here, if we have a corporate account, your RSPs, your TFSAs, whatever you need. And then the relationship develops over time, right? We'll come up with a if there is debt payment strategy, growth, equity growth strategy, like to build your equity, what accounts we're putting it into. Then we can get into, that would involve financial planning. We have a financial planning group here. We would look at your insurances. Most people have insurances through the different organizations at the provincial bodies like the Alberta Medical Association, etc. But we have an insurance group in-house where we can audit that and be like, do you have enough coverage? Because say you're the sole breadwinner in your family and you got $350,000 debt, what happens if you're crossing the street and get hit by a bus and can't work for 6 months?
Right.
So we got to make sure our risks are covered. And then, down the road, there's everything at our fingertips. We have Raymond James Trust if we didn't want someone in your family managing your estate, and Raymond James Foundation when you have too much money, you don't know what to do with it, and you can make your own charity foundation.
Give it to the
But
dogs.
the idea is that everything from A to Z, like you're not going to come in on day one probably and be like, hey, I need Raymond James Foundation, right? Like it doesn't happen like that. So it's really like long-term relationship. It evolves over time, and basically the better we know you, the ability to understand what you're trying to achieve. That's my job, is to deploy that in the easiest way possible.
I love that. I think it's that moment in time of remembering there's no judgment. This is not a situation where you're like, oh no, you have what for that? Like that kind of situation.
Absolutely not.
Physicians, I hear this all the time of, I wish the patients would have told me the full story, because then I can actually make a better diagnosis. I can support you
100%.
more if you tell me more, and there's no judgment. And I think that's really important for people to remember too, when they're getting into this, because I think that's, we've heard that's something that holds people back, is that fear of judgment, that fear of, oh gosh, embarrassment a little bit that our society and many's hold around debt and, maybe some of those spending habits. And I think it's just important for people to remember, hey, let it go. Don't worry about it. Get in there and start early and just have the conversation with wherever you're at.
100%.
Who's going to kind of be trustworthy and help you along that journey with no judgment and get you to where you want to be, because that's the ultimate goal, right?
Oh,
Jordan.
yeah. I've had clients come in and I've been good advocating at basically getting to, like as a physician, we want to work with you, and taking people from zero to like millions of dollars in their accounts, and just by having a game plan in place, right, where they didn't have it before. So I've seen it. People start at zero with a lot of line of credit, and we've paid it off at their pace that they want to do it at, and build equity. And it's kind of having a game plan in place, and being a partner, and having somebody hold you accountable at the get go, right? Yeah. That makes a big difference. Yeah.
Well, and I like that you talk about savings at the same time and as investing, and at the same time as paying off that debt, because things happen. Maybe you want to get that house, maybe you need that new car, maybe, you need to take some time off work for whatever reason. So yeah, it's great to have that whole investment portfolio and stuff too, but, making sure you're taking care of some of those different pillars of, holistically about your financial health, so that you can really, be set up for success. But you mentioned people getting started. Are there any fees? Like, tell me about what people need to think about when they're, hey, maybe I want to just invest my own money and wing it, and the fees are XYZ, or should I be working with a financial planner? What are those fees, and what should people know about that?
Yeah, that's a good question. So yeah, obviously, of course, there's going to be fees. You're paying for professional service here, and the idea is that our value outstrips the fees. Very fair, in line with market. The fee numbers are based on can be based on one I can adjust it to the client's situation on how, depending on their portfolio. For the most part, though, 95% of the time, it's fee for service. So depends on basically you're just charged as a percentage based on total account value. And how that works, it's an all-encompassing fee. And the reason why this way is the best, pretty much the whole industry is going this way, is that it aligns us and the client to the same. We both do better together. Right. There's also, it's crystal clear what the fees are. Nobody's going to be like, oh boy, like what was all this commission on a bunch of different trades? That doesn't happen when it's this. It's straight up. It includes all the trading, all the planning, call me as much as you need, like all-inclusive fee structure. The fee as a percentage decreases as assets go up. And the first hurdle, so basically, generally to get on our discretionary platform, you need $150,000. Now, note this, that I usually, for doctors, I go and advocate and I get you basically on the fee-based platforms from ground zero. And so, and then we come up with a game plan and start squirreling money in there, and it builds up over time. So that's a piece. The good things with it is, on our discretionary platform, is that say we wanted to make one trade across our entire business and buy, we wanted to buy Apple and sell Microsoft. That's not a trade we're recommending. I'm just throwing an example out.
So this is not trading advice. This is
not trade advice. Yeah, that's not a trade recommend. We can do it in one trade, so everybody gets the same price execution, because we're selling millions of dollars and buying millions of dollars. We're you'll probably get better pricing on that because it goes to our hard trade desk. Also, if there's foreign exchange involved, you'd get the mid rate. So these are like things that account for that. You're paying for it because it's part of your fee, but that's it's going to make up some cost. And the other thing with fees is written. You can write them off. Anything outside of your RSP and your TFSA is write off against investment income, and versus commission would be gain or loss. So it's a little more advantageous that way.
Thanks. I think that's great information. Whether people, I think a lot of physicians get approached routinely, if they're on LinkedIn or in many other ways, by financial advisors to work with them. And I think that can create a bit of a, and so I think what you just went over there, people rewind and rewatch, that's an opportunity for you to evaluate the people who you may consider working with in terms of what they offer you, how they can help you, what does their platform, what does their organization have to do. If you're, I think Mitch is great, but hey, you might be somewhere different. You might be getting approached, but evaluate your financial advisor, make sure they're there for you, that they're really going to support you in what matters to you across time, and that they are very, very well educated and well seasoned and have that depth of knowledge.
Yeah, you can, I could probably, go and change my own toilet, but I'm going to probably get a plumber in to do it, Same with, if I have a cold, maybe I could go pick up some cold medicine, but, I'll probably go see my doctor, right? You're paying for professional service, and that should, basically pay for itself in dividends, no pun intended.
I think that's the key.
Above and beyond what you're paying in fees. And I'll say the numbers are very fair. They're industry average. And for premium service, good, solid acumen. But I can also adjust the fee structuring depending on the client and how we want to work together. So I'm not going to quote any fees because of that aspect, but I'm like, if I talk to you one-on-one, I'm happy to tell you exactly what they are. It's crystal clear before anything happens.
And I know I'm just being wary of time. I know we're at that minute to go mark.
And there's no, and absolutely, there's no, like, if you call, we want to have a discussion on any of this, like there's no cost to that. That's just what I do.
Well, that's what I was going to say. Those on the list, we're going to share Mitch's contact information so that you have this, him as a resource to ask any of those questions, ask the silly questions, and ask the really, really in-depth questions if you're more knowledgeable, but don't hesitate to just get involved and start asking questions, because the sooner you start focusing on your financial wellness, then the better off you're going to be across time. So that about wraps us up today. Like I said, this conversation is recorded. It's going to be saved at Cherry Health. So if you want to watch this or come back for tidbits of it later, you can always join us at Cherry Health and go into those events to be able to see these resources in the future. We do have events every week coming up moving forward on a range of different topics. So please come and check out the events tab at cherryhealth.ca so that you can see what's next and what's going to be of interest to you to come and join. Jordan, any final words before we jump off?
I don't know if we have time. I was going to ask how buying a home factors into the investment strategy. That's just like, you see our parents in the previous generation, and that's like a significant portion of how they build wealth. How does that play into, I don't know, maybe we save
one final big question. Go for it, Jordan. I think if we go a couple minutes over, it's okay. I think that's a big one that matters to people for sure.
Yeah, for sure. Well, first of all, for a lot of people, their home is their largest asset, right? If you're going to invest in one thing. not to discuss how bullish or bearish I am on the Canadian real estate landscape. There is some cities where it's, unattainable to some degree. And also looking at the rates right now, if you had $1 million home, and say, just for sake of argument, say there was 0% down, at the 5-6% interest, you're paying $50,000-$60,000 a year in interest on that loan. But homes, it's an interesting asset class because it's one where you can actually use. You can't use your shares of Apple for anything. Your home's where you live. So I'm all about going and getting a proper home that you need. Don't overextend yourself. And it should perform pretty well over the long period of time. If you want to discuss mortgage rates right now, I could talk to you about how you want to do that. I probably would not fix in a mortgage at this rate. I'd probably float it. Because of the amount of immigration into Canada, I think, it's going to be a pretty solid asset class just because supply isn't there. So, they're not building enough new homes to basically cover how many, our increase in population. But on that front too, you want to be careful of how much money you're putting down against your home, and also it'll impact cash flow. Make sure you're not overextended because doctors' income's pretty sticky. We could pretty well calculate that out. And also you probably want to get 20% down on a home as well because otherwise you're going to be paying insurance on having an over-levered loan to value on the home. Home's a levered investment. Mortgage debt isn't bad debt to have because it's held against a asset class that's solid, and so it's naturally a levered investment to have. So you put 20% down. Say you had $1 million home, to make things easy math. If that increases in value by, let's call it 2-3% a year against how much money you've actually invested in it, basically makes it levered and can increase the returns. But I think it's just a good thing if you can afford it, if you're in the right spot. I mean, don't try and overpay and like force it. Get into something you like and are going to be into for a period of time. And depending on where you're at, there's cost to transact on homes. So depending on the province, Alberta is not bad, but Ontario is. And so on that front, I love real estate as an asset class. I think it'll do well over a long period of time, and it's an asset class that you use. So I think if all aligns, I think it's good to go purchase a home, right?
Might be something that the first bit of your conversation is around saving for it and making sure that
absolutely, and you can invest to save towards it. And also too, like if you buy a bond that expires in a certain period of time, right? Say you're like, I want to buy a home in 5 years, and I want to buy $1 million home. We could go buy a fixed income we could develop a portfolio that, okay, in 5 years you're going to have $200,000 to put down, right? Because you have the fixed rates of return. So there's definitely strategy around the home front for sure.
Gotcha. Thank you.
Great last
just
question.
ask, like, most of my med school friends, I would say, are renting versus buying. So it seems like a topical question.
It's tough right now. There's just not especially in Calgary here, there's just not enough homes for sale to make it spin. It's everything you're bidding and across Canada, and you're going to be overpaying. Interest rates are high, and we'll see what happens. But I could foresee, especially a city like Calgary, where you're going to have I think hundreds of thousands of new people moving here from across Canada, and that'll only push pricing higher. You think about you think in Canada, you have in the major cities, Vancouver's priced high, Toronto's priced high, Montreal's priced high. What are you kind of left with in terms of, reasonable real estate markets where younger generation can't afford to do it? And some of it's in Alberta, Calgary, Edmonton, Saskatoon, East Coast, I've heard, pricing's pretty high there. So it really depends, but it's all relative. When our parents bought homes, it's the opposite was the case because their homes cost a lot less, but the interest rates were a lot higher, right? So home pricing is adjusted to those types of things. Right now, it's just there's just not enough supply of homes and rates are high. So it's really kind of put us in a tough position. So I would be patient right now to find something, to be honest.
Yeah.
So.
Awesome. All right. Well, that's where we're going to call it today. Thank you again, Mitch, for joining us. Thanks, Jordan, for hopping on the call as well. And look forward to chatting again soon.
Okay.
Thanks, Mitch.
Thanks, everyone.
My pleasure. Thanks so much, guys. And anybody, feel free to reach out if you have any questions. Happy to chat.
Awesome. Thank you.
Take care.